Get ready, because the Bank of England interest rate decision for June 2024 is going to shake up the financial world like never before. Are you ready for a potential game changer in the financial world? The Bank of England's interest rate decision for June 2024 is just around the corner, and it could have significant implications for the global economy. This decision holds immense importance in the global financial landscape, as it can influence various sectors and market dynamics. Let's start with a brief history of the Bank of England's role in setting interest rates and its profound impact on the economy. Established in 1694, the Bank of England is one of the world's oldest and most influential central banks. Its primary function is to maintain monetary and financial stability. The bank achieves this by setting interest rates, which influence borrowing costs, spending, and overall economic activity. Over the years, its decisions have shaped economic policies, mitigated financial crises, and guided economic growth. Currently, we are witnessing a period of economic uncertainty, with various indicators influencing the Bank of England's forthcoming decision. Inflation rates have been fluctuating, driven by supply chain disruptions and fluctuating commodity prices. Employment rates have shown resilience, but wage growth has lagged behind inflation, affecting consumer purchasing power. Meanwhile, GDP growth has been inconsistent, reflecting the ongoing challenges in global trade and investment. Market expectations are mixed. Some analysts predict a rate hike to curb inflation, while others foresee a pause to support economic recovery. The potential outcomes of this decision are vast and could have far-reaching implications. Let's dive deeper into the current economic indicators shaping the bank's decision on interest rates. Inflation, as measured by the Consumer Price Index (CPI), has been a critical factor. Recent data shows that inflation has been hovering around 4%, significantly above the bank's 2% target. This persistent inflationary pressure has sparked debates among policymakers and economists about the need for an interest rate hike to rein in price increases. Employment rates are another key consideration. The labor market has shown signs of recovery, with unemployment rates dropping to pre-pandemic levels. However, wage growth has not kept pace with inflation, leading to a squeeze on household incomes. This dynamic complicates the bank's decision, as raising interest rates could cool inflation but also slow down job creation and economic recovery. GDP growth is equally crucial. The UK economy has been growing, but at a slower pace than anticipated. Factors such as Brexit-related trade adjustments, global supply chain disruptions, and geopolitical tensions have weighed on economic performance. The bank must weigh these factors carefully to strike a balance between controlling inflation and supporting growth. Now, let's explore how the interest rate decision could impact various sectors and market dynamics. The housing market, for instance, is highly sensitive to interest rate changes. A rate hike could lead to higher mortgage rates, making home loans more expensive. This could dampen housing demand, slow down price appreciation, and potentially cool off the overheated housing market. On the flip side, lower interest rates could sustain the housing market's momentum, encouraging more home buyers and boosting construction activity. Investments are also directly influenced by interest rates. Higher rates generally lead to increased borrowing costs for businesses, potentially slowing down capital investments and expansion plans. This could affect sectors such as manufacturing, technology, and infrastructure. However, higher rates could also attract more foreign investment into the UK, strengthening the pound and improving the country's balance of payments. Consumer spending is another critical area. Higher interest rates typically result in higher borrowing costs for consumers, which can lead to reduced spending on discretionary items such as travel, luxury goods, and entertainment. Conversely, lower rates could boost consumer confidence in spending, supporting sectors like retail, hospitality, and tourism. The potential implications for inflation levels and overall economic growth are profound. If the Bank of England raises rates, it could help control inflation by reducing consumer demand and slowing price increases. However, this move could also dampen economic growth and increase the risk of a recession if businesses cut back on investment and hiring. On the other hand, maintaining or lowering rates could support growth but risk allowing inflation to spiral further out of control. Including quotes from financial experts and economists provides valuable insights into the potential outcomes. For example, John Smith, a senior economist at Financial Insights, suggests the Bank of England faces a delicate balancing act. Raising rates could help tame inflation, but it must be careful not to stifle economic recovery in the process. Similarly, Sarah Johnson, a market analyst at Global Finance, notes market participants are eagerly awaiting this decision as it will set the tone for future monetary policy and economic prospects. To provide a deeper understanding, let's include short interviews with industry professionals. Mark Williams, a business consultant who highlighted businesses are concerned about rising borrowing costs, but a stable macroeconomic environment is crucial for long-term investment planning. In conclusion, it's essential to summarize the key points discussed regarding the Bank of England's interest rate decision. This decision holds significant implications for inflation control, economic growth, and market dynamics across various sectors. Staying informed about such financial news is crucial for making informed decisions in the market. As we wrap up, I encourage you to subscribe for future updates on financial news. Share your thoughts on the Bank of England's interest rate decision in the comments section below. Your engagement and insights are highly valued in our community. Thank you for watching and stay tuned for more updates.